Hello, everyone. 2022 last minute Roth IRA conversion tips. Really important video. I hope you guys will enjoy it because it's super important. This is actually probably the best time in the last 14 years to take advantage of the Roth IRA conversion rules. Okay, and probably the third best time in the last 20 years where we all can take advantage and maximize our ability to generate Roth returns by doing Roth IRA conversions at super depressed prices. Okay, so on today's video, just to set the agenda, what I want to do is kind of cover what a Roth IRA conversion is, number one. Number two, talk about why this is probably the last great chance to take advantage of it, sitting at the end of December 2022. And then finally, talk about some tips we can all take into account over the next 9 or 10 days. So before I get started, I just want to wish everyone a happy holiday season, happy New Year, happy everything. I hope 22 was a great year, and I hope 23 will be even more prosperous and successful and healthier for you and your family. So just wanted to kind of get that out of the way. I know everyone's busy with last minute Christmas shopping. I know it's a lot of cold weather on the way this weekend, a lot of storms. So just wanted to thank everyone for really supporting me and all I do to try to bring up to date and relevant content to all of you on various self-directed retirement topics. So, which I obviously think is super important. Ultimately my goal is to make everyone the best and most savvy self-directed investor out there. So let's get to it. So what's a Roth IRA conversion? Okay, so let me just sum it up for everyone. Since 2010, there are no income limitations on who can do a Roth conversion. Prior to 2010, if you had more than 100,000 in net income, you couldn't do a Roth IRA conversion. So what's a conversion? It means you take a pre-tax asset, a pre-tax IRA, pre-tax SEP, a pre-tax simple, a pre-tax 401k, and you convert it to Roth. And what's the point of doing that? What does a conversion mean? It means you take an asset that was pre-tax that potentially has deferral and taxable income when you pull the money out, whether it's by age 59 and a half or at age 72 for required minimum distributions. And what it does is it takes that asset, puts it in the Roth bucket. And the Roth bucket since 1997 is a bucket that is a tax-free bucket, meaning so long as you're over 59 and a half, the Roth's been open at least 5 years, you can pull all the Roth IRA funds out tax-free. Okay, so that is a super tax opportunity for anyone that's savvy enough to understand that, hey, if I could take an asset that I may have to pay tax on, and I could put it into a bucket where it will be tax-free, hey, that's the ultimate tax shelter. That is the best legal tax shelter out there. And I always say this, and it's true. One of the first classes I took in law school, at least federal income tax, the professor, I still remember it vividly today, said every good tax lawyer wants to do two things. Either help their client defer tax by generating deductions or credits, or ultimately eliminating tax. Okay. So that is the ultimate goal for any tax attorney. So what the Roth IRA does, and why I'm such a big Roth lover, why I wrote a book, God We Trust and Roth We Prosper, is it is the best legal tax shelter out there where you can literally shelter your assets legally from tax. Okay. So why is the conversion so important? Well, Roth IRAs generally can only put in $6,000 or $7,000 if you're over 50. Yes, Roth solo 401ks, you can do deferrals of $20,500 in 2022. You can also do what's called a mega backdoor, which will let you go up to $61,000 or $67,500 if you're over 50 in 22. But not everyone could get into a solo 401k mega backdoor. And if you have to go year by year, $6,000 or $7,000 a year, it's going to take some time to really build up your Roth nest egg. Enter the conversion. So since 2010, what happened in 2010? Well, we know in 2008, 2009, we had a financial meltdown, financial crisis, lots of job losses, and the IRS needed revenue. Why? Because people were making less money. They were paying less taxes. So they said, hey, let's get rid of these income limitations. So let's let everyone do conversions. And you know what? If you do a conversion, we're going to let you pay that tax over 2 years. Now that ended in 2011, but the idea is they wanted to stimulate tax revenue. And believe it or not, the IRS loves Roth conversions. Why? Because you're paying tax prematurely, right? Generally, if you had a traditional IRA, let's say it's some real estate in there or some stock, you wouldn't technically have to take distributions till you hit the age of 72. Now you can always take distributions over 59 and a half and just pay income tax, but a lot of people will wait to 72 and then just take what's called required minimum distributions. But when you do a Roth conversion, you pay taxes up front. Yes, you pay ordinary income tax, not capital gains tax. You pay ordinary income tax, but you're paying it up front. So why is 2022 such an important year for Roth conversions? If you take anything away from this video, and hopefully you're watching this in 22, because once 23 rolls around, this strategy dies, okay? Because Roth conversions for 22 must be done by 12/31/2022, okay? Now you may have some flexibility if it's an in-kind asset to actually like process the conversion, but technically you need to get the paperwork in, especially if you're doing publicly traded securities or cryptos, things like that by 12/31. So that's why if you're watching this video in January, it's like, maybe kind of difficult. So why is 22 so exciting? Well, we know what happened in 22, right? We are in a period of high inflation and most assets are down. Okay, and I got some numbers for you and I'm going to share some data so you know I actually prepare for these videos, right? I feel like I'm back as a tax lawyer doing prep for clients, but I do. I don't just come on this video and just kind of talk. I prepare, and I want to give you the best information and best and most accurate data. So here it is. So the S&P 500 is down about 19% this year. Dow's down about 10%, and this is as of December 20th, 2022. Nasdaq's down about 32%. Tesla's down about 65%. Meta's down about 64%. Gold's actually, basically flat. Silver's actually up almost 4%, which is great. Obviously, we know cryptos. Bitcoin's down about 65%. Ethereum about 66%. The only assets that have really done well are commodity shares, oil, like Exxon's up 70%. But even real estate, private placements, hedge funds, private equity, private businesses have seen their valuations decrease. So let's just kind of focus right on traditional equities for now. So I'm going to just kind of give you some interesting information to chew on. So if you look at the S&P 500 over the last 20 years, there hasn't been many loss years. Okay, this is actually the potentially third biggest loss year in 20 years. So we're down, as I mentioned, about 19.8%. In 2018, we were down about 6%. And then the next big year was 2008, we were down almost 39%, but 38.49%. And then 2022, we were down about 23%, and 2001, about 13%. So if you look since 2001, we've only been down about 6 years out of 20. And this is the third largest. Okay, so what's good about being down? Well, not a whole lot, right? But the one advantage of being down is if you have assets that you really like. So if you really like Tesla, and I do, not so much a Meta, but if there's other stocks, like my kids really like Snap, some other social media companies, and you're like, hey, I'm a long-term believer in Tesla, or I'm a long-term believer in Bitcoin, or I'm a long-term believer in this private business, the valuation's down 10, 50, 70%. Why don't I convert it today? I still have clients that talk to me about 2008 and say, Adam, the best thing ever happened to me was 2008. My stocks were down almost 40%. My real estate was down like 45, 50%. And I was able to do conversions at that price. And now everything's gone up like 300-400% since then. And it's all in a Roth. Okay. So obviously, how do you value this stuff, right? That's the first question. Well, if you're valuing equities, mutual funds, ETFs, cryptos, that's easy. Gold, silver, right? Publicly traded, super easy. You look at the close of business, 12/31, and it's very easy to determine the value. Okay. If the asset's not marketable, right? It's private business, maybe a hedge fund, private equity, maybe a piece of land, real estate, things where it's not mark to market every day or every week or every quarter. What do you do? Well, real estate, there's online sources, right? There's Zillow, Trulia, tax records, where you can come up with a fair market value quite easily. And that's something you would use, right? You generally want to get an independent party give you a value. Doesn't need to be a big accounting firm, a top 4 accounting firm, but it needs to be someone independent, whether it's tax records, Zillow. If you're trying to convert private business stock, private business interest, hedge fund, private equity, you want someone independent, whether it's the promoter of that fund, the manager of that fund, or an accountant or some third party. Why? Because it's a taxable event. When you do a Roth conversion, you pay ordinary income tax on the fair market value of what you convert. If you bought real estate, for example, at 100K in 2016, and now it's worth 400K, and you want to convert it, you're paying tax not at 100K, but on 400K. Same thing with Tesla. If you bought it at 400 a share, now it's at 135, you pay tax at 135. Okay, so it works both ways. And whatever that amount you're going to convert, you don't have to convert the whole asset, right? If you have 100 shares of Tesla, you can convert 1 share, 10 shares, or 90 shares, or all 100. And that amount, that value is added to any other income you have, whether it's W-2, other income on your 1040. It's all aggregated together, and then the tax rate would apply to the aggregation of that income. Okay, so that's kind of how it would work. So it's hard to me to say how much you would pay, what your tax rate is, because it's dependent on other sources of income as well, not just your conversion amount. Now, that obviously brings into bear other tips and other strategies, i.e., you had a down income year, right? Your business didn't do great, or you took less salary this year, or you have net operating losses from your business. That may help and may accelerate and incentivize you to do a Roth conversion. Why? Because all those losses or a lower tax base will make taking a Roth conversion option less painful. Why? Because let's say in 21 you made 100K, right, of net income. And this year it's down to 40 because of you have other losses or flow through deductions or whatever the case may be. So now if you did a conversion of another 40, your income would be 80 instead if you did it last year or 2 years ago, maybe 140. Plus, if that asset you're converting was valued at 100,000 and now it's at 40,000 and you believe it's going to go up considerably in the future, that's when a conversion makes even more sense. So before I get into who should do conversions and who shouldn't, just based off my chart, again, let's just summarize. Roth conversions is when you take your pre-tax asset and move it to a Roth, pre-tax to Roth. When you do a conversion, if you're under 59.5, you have to wait 5 years until you're 59.5 to pull the amount out of what you converted. If you're over 59.5, you don't have to wait that 5 years to pull what you converted out, but the earnings on the amount you converted. So if you converted $100,000 and that 100K turns into 130 because of the investment returns, the 100K, if you're over 59.5, you can pull out the next day. Whereas if you're under 59.5, you'd have to wait the 5 years and the 59.5. But since you're over 59.5, you can pull out the amount converted any time, but the earnings on what you convert, you have to wait 5 additional years to pull out the earnings. Okay, so just something a lot of people don't realize when you do conversions. But remember, it's ordinary income, capital gains. It gets aggregated with all other income you have. And you got to pay the tax by April 15th. So number one, can you pay the tax, right? Like Roth conversions in reality, in practice, are awesome, right? Everyone would do it. Everyone would get all their pre-tax assets to Roth. But you can pay the tax on it, right? So that's the toll. So you got to make sure you can afford the toll, right? It's like everyone would have a Ferrari, but you got to afford to pay the Ferrari costs each month. So that's number one. I'm not a big believer in dipping into your Roth conversion amount to pay the tax. I just don't think it makes sense. Okay. So number one, can you pay the tax? Number two, do your numbers, right? Run the numbers with your accountants, your tax professionals. Do the math. What's your tax basis? You have deductions, you have losses. How much is it going to cost you? You can do rough estimates, right? Not everyone has all their tax calculations in December. Generally takes a few more months to kind of put it all together. But you have a rough estimate. You have W-2, you have deductions, losses. Where do you think you'll stand? And then you can just go and check the tax rate based off your net income, right? With the highest tax rate being 37% and the lowest being 0, and then maybe you're somewhere in the middle. Your age matters, right? If you're 21 years old, you have a lot more growth potential than if you're 79 years old to do a conversion. Why does age matter? Well, when you're younger, you have more opportunity for that money to grow. Okay, whereas if you're 79, less of a window. So that means your Roth has the chance to grow even more significantly the younger you are. Now, the one nice thing about being old or older, I shouldn't say old, is let's say in your 60s or 70s, is you may have a better idea what your tax situation will be over the next 10 years, right? You may say, you know what, I'm retired, like I don't need a lot of income to live, my house is paid for, I live a simple life, I'm retired, I don't need that much to live, so my tax rate will be relatively low. You know what, a conversion maybe doesn't make that much sense because my tax rate will be around 20% anyways. So I could just pull out what I need without paying all the tax right now. Now, if you, on the flip side, said, you know what, my tax rate is going to be 35% plus, I'm going to make $300,000-400,000 grand a year easy on my investments, then maybe a conversion now makes sense considering the two factors that assets are depressed, values at least, and maybe you have some losses to offset the income. So age matters, your ability to pay matters, your tax situation matters, and ultimately, like, what's your belief in what you're doing, right? If you are like a really amazing investor, or if the asset you want to convert, you truly believe in, let's say I love Tesla, I think that stock's going to go back to 400 or 500 guaranteed, like I would put my life on it, then converting Tesla at 135 makes a whole lot of sense. On the flip side, if you're like, I don't know, this Elon Musk, he's too busy with Twitter, a lot of the car companies are getting to the electric vehicle marketplace, I don't know, this guy's too crazy, I don't really feel that comfortable with Tesla, then maybe you don't want to convert to Tesla, right? You may be saying, I don't want to pay tax upfront on the 135. Let me just pull out what I need going forward. Okay, so you don't have to do conversions, but you can do it on a percentage, fractional interest, or all of what you want to convert, right? You can say, you know what, I got 100 shares of Tesla. I'll do 25 a year for 4 years. Just space it out. So this way your income doesn't go from here to here, right? It doesn't go from, say, 100,000 to 400,000. Just do it gradually. So you do have flexibility. Okay. Just to confirm, pre-tax IRA versus Roth. I think this is super important. I just want to really focus on this one last time. A pre-tax IRA, you get a tax deduction when you make the contribution, but if you pull the money out prematurely before 59.5, you pay tax and the 10% penalty. If you pull the money out over 59.5, pay tax. When you hit 72, you have to take what's called required minimum distributions. There's new legislation, which I will do a live video on in the next week once it gets signed into law by the president, is going to be pushing the RMD age to 75 over the next 10 years. That's called the Secure Act 2.0. So, look out for that. Whereas a Roth IRA is kind of the flip side, right? It was created in 97 by Senator Roth, Delaware. And basically, it's an after-tax account. So you do not get a tax deduction, but so long as you're over 59.5 and the Roth IRA has been opened at least 5 years, it's all tax-free. And there's no RMDs, no requirement of distribution. So it's super attractive, and being able now with no income limitations to go pre-tax to Roth, especially with depressed asset value prices, this is could be the last opportunity we're going to have for a number more years, right? Prior to 2022, 08 was the last time we've seen 15% or more of depressed values. And it's not just equities, right? It's going to be, it's cryptos, it's real estate. Almost everything's down other than silver and oil and other commodity shares. Like everything is down. Monster hedge funds, monster private equity funds, monster real estate funds, right? House flipping, everything's getting killed. Real estate values have also been depressed, not to the extent of Tesla or Meta, but they're down 10 to 30%. Again, from a valuation standpoint, you have more flexibility from a non-liquid or illiquid in-kind asset like real estate, private business, private placement type investment than a publicly traded asset like stocks or crypto. So that means you can look for discounted valuation. Obviously something that's reasonable, right? If you bought a piece of land and you're in, I don't know, Austin, Texas for $100K, you may not be able to say it's worth $12,000 now, but maybe legitimately it's only worth 82 now, right? Or 85 or 75. So you do have some flexibility because it is more liquid. The valuation needs to be fair and reasonable, and you need to have a third party sign off on it. But with a high interest rate environment, with a real estate market that's essentially frozen, not a lot of buyers out there, prices coming down, you definitely can get you can get away with a lot more today than you would have been able to 6 to 8 months ago. So my point is, hey, as a tax lawyer, yeah, it sucks to be down. I don't want to look at my statements, right? We're all down. I have a good amount of my net worth in equities, right? On my 401k, a lot of my 401k, not a lot of my IRA, but a lot of my 401k and some personal savings are definitely in equities, ETFs, mutual funds. They're getting slaughtered, right? Down anywhere from 10 to 16%. And that's with good money managers. So no one wants to look at those statements. But on the flip side, in the retirement world, you can actually take advantage of it by doing conversions. In the investment world, if you're using personal funds, the best you can do is really a $3,000 capital loss, which can go to offset ordinary income. And that's something everyone should be doing. Everyone probably has at least $3,000 of losses this year. That is the maximum you can do to offset ordinary income. So that's a no-brainer. Everyone should be getting that $3,000 deduction. But otherwise, all you can do is have your capital losses offset your capital gains, which doesn't help your net earned income number. Up to $3,000 you could, but $3,000 only gets you so far. So the conversion ultimately is the best advantage of a downsizing, definitely falling equity investment marketplace, is you can actually do some good with it long term by doing a conversion. Now, again, you got to be able to pay the conversion, pay the tax. You got to run your numbers. Age matters. Your investment savviness matters, and ultimately, your ability to wait. If you're not a patient person, do not do a Roth conversion. Why? Because generally, as I mentioned, you got to wait till you're 59 and a half, or the Roth's been open at least 5 years. So if you're not patient, you know yourself, you just aren't going to be able to resist taking Roth distributions. Don't go for it. It's not worth it. Why? Because you're paying tax now, and you're not going to benefit from it. And I have to mention worst case scenarios, right? Worst case scenario, imagine you did a Roth conversion of Bitcoin in January 2022 or December 2021, and you did a conversion at Bitcoin at 55,000. You're not feeling really good now, right? Or let's say you converted Coinbase when it was at 400 and now it's at whatever, $45, or Enron or Bear Stearns, things like that. Those are worst case scenarios, but it could happen, right? The private business stock that you're going to convert, maybe it goes bust in 2 years. On the flip side, maybe it becomes a unicorn, and that amount that you converted is now worth 13, 15 times, and it's all tax-free. But there's no guarantees in life. There's more guarantees by converting publicly traded securities like a Tesla or a Meta or something like that than a more risky asset like an altcoin. But it's up to you, right? You just need to know the downside is you pay tax at a value, even though it's depressed, and then that value never comes back, right? The company goes bust, or the coin just kind of falls apart. So keep that in mind. But again, I just wanted to focus on this. This could be the last great opportunity for the next several years. Again, over the last 20 years, we've only had the S&P 500 down over 10%, like 3 times, 3 or 4 times, right? And definitely over 15%, only 3 times. The last time was 2008, and before that, really, it was 2002. So over the last 20 years, this is the third, arguably second to third best time to do conversions. And then if you count in cryptos and other assets, this could be a game changer. And as I mentioned, I got a lot of clients from 2008 that still talk about what an unbelievable opportunity that was. And they're so happy they did it. So I know there's not a lot of time left. I've been talking about conversions over the last 6 months as asset prices have decreased, but just keep my tips in mind. Your age, ability to pay the tax, your savviness. Do you really have faith in what you're investing in? Are you a patient person? and what you think your tax rate will be once you retire. If you think it's going to be super high, then Roth conversions have more value today. If you think it's going to be super low because you're not going to need a lot to live and you have a simple lifestyle, then maybe a Roth conversion does not make a lot of sense, since your tax rate will probably be very low in the future. Now, people say, well, Adam, what do you think the tax rate will be in the future? I have no idea. What do I know? Right? I can tell you what the tax code says. I don't know what Congress or Senate will do in the next 10, 20, 30 years. No one does. But my thought is, I don't really want to know. That's why I'm doing a Roth. I'm going to isolate the government from my investment planning. Now, I'm always reminded by a mentor of mine who always says, hey, Adam, things can change. Before 1982, Social Security was not subject to tax. Guess what? They changed the rules on you. The Roth IRA rules can change in 10, 15, 20, 30 years. Some president, some member of the House or Senate could try to pass a bill that says, you know what, we need money, and let's just tax all Roths, even if it's at a lower tax. Yeah, it sucks. We're going to change the rules and really screw some retirees, but who cares? We need to pay for X, Y, and Z. It could happen, right? And that's just the wild card that no one knows about. I don't know. You don't know. No one knows what's going to happen 10, 20, 30 years. But I'll take my chances. I'm 47. I need to get to 59 and a half, and then I can start pulling money out tax-free. I've slowly moved all my assets to Roth, all my cryptos, all my real estate. I do only Roth 401k contributions. So I'm definitely married to the Roth concept. I totally understand. I've gotten into some really good debates with clients, friends, about why pre-tax is better, because you get the current deduction. You guarantee you can lock in that deduction, and you don't have to worry about the government changing the rules on you in the next 10, 20, 30 years. But again, I think I'll be in a better position in those years when I'm not paying any tax on my assets. But last thing I want to mention, again, you got to do this by 12/31. With equities, cryptos, publicly traded stuff, you really got to make that election. Let us know a day or so in advance. Some paperwork you need to fill out. If it's a liquid like real estate, land, you may have some flexibility by completing the paperwork and providing valuations a little bit later. But you definitely want to elect to make the valuation conversion by the 12/31. You can't do it in January, February, March for the 2022 taxable year. So you got another 10 or so days, kind of regroup. I know it's busy holiday season and stuff, but spend an hour, kind of look at, if you're married, talk to your spouse and see, hey, what's our income? What are some of the deductions? Do we have any pass-through losses? Like, what do you think our income base is going to be? And kind of look at the tax rates. What do you think the tax rates will be? You can just Google 2022 tax rates. It's not super complicated. And then say, okay, these are my IRA assets or 401k assets. What do you think we can do? Maybe you have 200K in total. Let's convert 50. The 50 conversions not going to move us to a higher tax rate. And then let's do it over the next 2, 3, or 4, or 5, or 6, or 7 years, right? Have a plan. The plan could change, but stay on that path. And ultimately, hopefully you get to the point where everything's Roth and you're sitting pretty at 59 and a half. You have no RMDs when you're older. You can pull out whatever you want without tax. And ultimately, wherever the tax rates go, I promise you they're not going below 35%. I don't care who the hell's in office, Democrats, Republicans. We need the money. Tax rates are not going to go below 35%. I can promise you that. They can definitely go to 50%, but the top tax rate is not going to go below 35%, I don't think, in the next 20 years. Could be wrong, but I don't think so. I think there's a better chance it goes higher than lower, considerably lower over the next 20 to 30 years. And I'm not going to care because it's all going to be tax-free either way. So let me get to some questions. I got some ones. Adam, can you tell me what is the tax percentage of converting the deferral monies into Roth? So as I mentioned, I can't give you the tax percentage. No one can, because it's based off your tax bracket. Okay. So as I mentioned, you got to aggregate all your income. So let's say you make 100,000 here, you have other income here, and then you could add conversion to that amount. And then you can simply Google what your tax bracket is based off tax rates and kind of get an idea. It's not super difficult at all. So I can't give you anything more than that because it's really based off your situation. But here's some numbers to chew on, right? If you make more than 550,000 or so, you're going to pay 37%. But if you're making, let's say you make between 89 and 170, maybe you're at, married, file jointly. If you're making more than 650, you're at the highest tax bracket. But let's say you make between 178 and 340. Let's say you make 200. The next tax bracket may not be till 350. So you may have some flexibility to stay at that 24% rate. Let's say the 22% rate is between 83 and 178. So let's say you make 110 combined. You have another 50 or 60K before you go from 22 to 24. So that's why check the tax brackets. Okay. I'll put this link in the chat box. This is just from Tax Foundation, but this will give you an idea to go and just kind of check your tax brackets, add your income, check the tax bracket and say, okay, I'm at 100. I got another 60K to play with. Let's convert it. And my tax bracket is not going to go up. Will you speak at Secure Act 2.0 last minute provisions in the context of last minute conversions? Well, the Secure Act 2.0, if it passes, it's generally not going to be for 2022. It's going to be for 23. So I wouldn't worry about it. I'm going to do a separate video probably next week. Depends when it passes. Probably not tomorrow. Probably next end of December 2022. Kind of spend some really good time going through all the key provisions. It's in the omnibus bill. It's gonna pass. It's just a matter of when. So once it passes, I'll spend some time going through it. There's some cool provisions. I'm actually, super supportive of it. It's a great bipartisan bill. Again, I'm not talking about the whole omnibus bill. I'm just talking about Secure Act 2.0. It's like a 1,500-page bill. I'm sure there's some stuff I'm not super thrilled about, but the retirement stuff is really good. Is it possible to convert a portion of my 401k to Roth IRA? So if you're in a 401k, you can convert, assuming your plan is a conversion option, you can convert pre-tax 401k to Roth 401k, but only when you're over 59 and a half will you likely be able to go Roth 401k to Roth IRA. Why? Because you need a trigger event to get your funds out of a 401k. But again, if you're in a Roth 401k, who cares, right? That's good. You're still in the Roth world. And then if you leave your job, you can just go to the Roth IRA world to get more investment options. But even if you have to stay in the Roth 401k world, it's all good because you're still Roth. As a rule, how many years does it take to recover the taxes paid to convert? Great question. I don't know. That's a straight answer because it all depends on your investment performance, to be honest, right? I mentioned the Bitcoin example. If you converted a 2021 Bitcoin today, it may take you a bunch more years, right? Who knows where Bitcoin will go in 23? But based off FTX and some other stuff going on, I don't think the price of Bitcoin is going to go back to 60 for a bunch of years. So you just may be in a waiting game. Whereas Tesla, who knows? Maybe in a year or 2 years, it's back to where it was. So I don't know. That's the risk of the conversion, right? That's the chance you take. It's not as risky as just like betting on black 15 in a roulette wheel, but it definitely has some risk because even if you strategize perfectly, I'm patient, I'm young, I can pay for the tax. If you make the wrong bet, it can never come back, or it can take 3, 5, 10 years to get your asset back to where it was pre-conversion. So that's the bet. That's why the IRS likes it, because it's money in the bank. And even if your asset goes 10x, it's generally going to take some years, and that's the next politician's issue, right? Current politicians, Congress, Senate, executive branch, they only care what's going to happen in the next 4 to 8 years. They really don't care what's going to happen in the next 10, 15, 20 years. We'll see. That's just kind of the way it works. As a rule, okay, why was the donation provision removed for 2022? Well, I believe if you're talking about the donation of IRAs up to $100,000, I'm not sure it was removed. There's not a lot of guidance on that. It still technically applies if you're 70 and a half. They haven't pushed it to 72. I don't think the Secure Act 2.0 removed it, so I'm not sure if that's the case. Will Roth be double taxed someday? I hope not, Patrick. But as I mentioned, who the heck knows, right? It's possible. The whole idea of a Roth is it's not double taxed, right? You pay the tax today, whether you do a contribution or conversion, and then once you pull it out, it's not subject to double taxation. Patrick, you don't seem to have a lot of faith in the government. I hope you're wrong. I hope the government keeps its bargain. We saw it with the Build Back Better bill that sometimes the members of the House or the senators get some wacky thoughts in their head and try to do things too quick without really thinking thoroughly. And thankfully, clear heads prevailed and the Build Back Better wasn't passed. But hey, Patrick, I mean, I can't say you're 100% out there, right? It's super possible that the government does change the rules, bends the rules in the next 10, 15, 20 years. I hope you're wrong, but I can't say you're 100% mistaken. So I will look at the loan provision. Again, that only applies if you're over the RMD age, do up to $100,000 instead of an RMD and use that as a donation to a qualified charity, but we'll see. Can you net partnership losses against ordinary income generated by a conversion? David, if it's active business income, yeah. If it's passive, potentially not, depending on how that partnership loss is, right? There's at-risk rules under 465, passive activity limitation losses in 469. That's why sometimes you want to huddle with your tax advisor now if you can. Yeah, it's easier after 2022 is gone, but if you really want to take advantage of conversion and you think you have some pass-through partnership losses, do a quick call, David, with your tax advisor. Make sure those losses will pass through. If they're active business, they should. But if it's real estate or other investment, it may be passive, and you may have some at-risk rules you have to address. So that's why maybe a quick call with your tax advisor pre-12/31/22 would be advisable. I do my taxes. The $3,000 stock loss only takes off around $300 from taxes owed. Think that should be clarified. It's not that the $3,000 take directly off the total amount of tax owed. Well, Ken, great point. Deductions simply reduce your taxable base. Credits reduce the tax owed dollar for dollar. That's why credits are better than deductions. So if you made $100,000 and you got a $3,000 deduction, you pay tax on $97,000. Okay, that's a deduction. So generally, if you pay a 30% tax, the $3,000 deduction, you're right, it's about $1,000. Say 30% of $3,000, about $1,000 saving, $900 saving. Correct. A credit is way more tax advantageous, right? Let's say you made $100,000 and you pay $20,000 in taxes, you get a $3,000 credit, you only pay $17,000 in taxes. So credits trump deductions, but the problem is, Ken, way harder to get credits than deductions. Just the way it is, right? The IRS doesn't just shell out credits so easily. Deductions a little bit easier with if you itemize versus standard, charity, things like that, and also just losses from active businesses will deduct your and impact the amount of net income subject to taxation, but correct, it does not reduce taxable income dollar for dollar like the credit does. So thank you, everyone. Those are some amazing questions. This is fun stuff. Get to be a tax lawyer again. It's all good. Again, these rules can apply whether you're a self-directed IRA investor or not. You just need an IRA or a pre-tax 401k, whether you're converting stocks, mutual funds, ETFs, fixed income, bonds, or alts like cryptos, real estate, private placements, private business investments. This is a great opportunity. It's a crappy year for investments. As I mentioned, it's super depressing to look at our statements and see our assets depressed. But silver lining on that, silver lining is it's a great opportunity to do conversions. Probably the best one, as I mentioned, since 2008. Okay, so if you can do it, you can pay the tax, you're young enough, you're patient, you want to trust the process, you are savvy enough and you feel comfortable in what you're investing, and you do feel that your income will be high enough when you retire that having a Roth and a tax-free account is something that's advantageous, then definitely consider a conversion. I'm not telling anyone to do conversions, right? This is a personal decision. It's based off your personal tax position, your investment savviness, your personal thought process on what you're doing. But it's my job, and what I like to do is kind of give you the rules from a tax standpoint, from an IRS standpoint, as to these are the rules, this is how the game's played, this is the game is kind of tilted in our favor today, right? It's like the rules are changing really quick just for this year. It's like they put a 3-point line on the court just for this year. So we all can take 3-pointers instead of 2-pointers. And that may go away next year, right? If the markets go up 20, 30, 40%, like they did in 2009 after 2008, you may not be in this situation. Now, we'll be happier because we're going to see our asset values rise, but you may not be in a prime conversion space because those assets are increased in value. So just something to keep in mind. Last question. If converting an LLC IRA, does the money need to actually travel back to the IRA Financial? No, David. You just do an LLC conversion. So it's a great question. Let's say you have an IRA owns an LLC. Let's say it has $10,000 cash and 5 real estate assets and 20 Bitcoin. Okay, you're just going to convert the LLC. So the LLC, let's say, is valued. It used to be valued at $400,000. Now, arguably, you think it's valued at $200,000. Okay, all you do is an in-kind asset of the shares of the units. We'll amend the operating agreement. Let's say you convert 50% of 100. So let's say it's a 200 value. You convert 50%. You pay tax on 100. We'll amend your operating agreement, and the LLC is now going to be owned 50% by the pre-tax IRA, 50% by the Roth IRA. Okay, whatever those percentages are, whether it's 10%, 80%, 100%, we will just amend your operating agreement for you. So conversions of LLCs are super easy because the assets don't need to be retitled. You don't have to worry about each particular asset. All you need a conversion at the entity level to do a conversion. Okay, so great question, David. I should have addressed that earlier. Whereas if you own an IRA or 401k owns an asset directly, let's say you have an IRA owns a piece of land, and the title is IRA Financial Trust Company for the benefit of the Adam Bergman IRA. And it's just that piece of land. I'll convert that asset separately and then retitle it to Roth IRA. Okay. Whereas if it's in an LLC, if it's 1, 2, or 3, 4 plus assets, you're just going to retitle the LLC operating agreement. The LLC still stays the same, right? So let's say my LLC is called 123 LLC. It owns 50 pieces of land, and I want to convert percentage of 123 LLC. I don't convert only land A or land B. I have to convert it at the entity level. So proportionally, if I'm converting 2%, it's 2% of everything the LLC owns will become Roth. Okay, so you got to consider that. But great question. Last one. I got the questions are going. You guys are awesome. This is a super important topic. I'm happy that people are taking this seriously. I'm telling you, you're going to come back. And I hope as the markets increase in value over the next 3, 4, 5 years, you guys are going to call me back in 4 or 5 years and say, Adam, I remember watching that video in December 22. 22 was such a crappy year, but I listened to you. I did conversions. I had losses or deductions. I got through paying the tax. It sucked. I got through it. And now those assets are worth 3, 5, 10 times worth. And it's all tax-free. What about a relative loaning you money from an IRA? Do they have to pay taxes? Well, Wade, if anyone lends you money, they're a lender. So the interest that you pay them is subject to tax, right? As long as they're not losing their IRA. If an IRA is lending you money and the IRA receives the interest, there's no tax. Interest is exempt from tax. But if I use personal money to lend your IRA, Wade, money, Adam, individually, and you pay me $1,000 of interest a year, yeah, that $1,000 is subject to tax. Okay, so just keep that in mind. It's a very good question. So be on the lookout. The next video, and I may drop it before next Wednesday. Depends on when things pop, when the bill gets passed, whether it's Friday, Monday, Tuesday. I may just kind of go live. So it's another reason. Definitely subscribe to this channel because you will get IRA Financial. You get notified when I go live, and you're not going to want to miss the next live because it's going to be about Secure Act 2.0. And I promise you, there's some really cool provisions. And I'm going to probably spend the next 2 days kind of going through them. As I mentioned, it's a monster bill, and the retirement provisions are kind of stuck in the middle of them. So let me do it. Let me do the dirty work for you guys. You don't need to go through the bill. I'll put my tax attorney hat back on, and I'll get dirty and kind of go through all the provisions and focus on the ones relating to IRAs, self-directed IRAs, solo Ks, all the important stuff. And trust me, there's some actually goodies in there that you're going to want to think about and learn about because you'll have to be ready for 23. So That's it. Appreciate you guys spending some time with me today. I know it's a long video, but it's a super important one. I really, if you take anything away from today, give your accountant a call, your tax advisor, send him or her an email. Just consider the conversion. I saw it in 08. I wasn't around in 02. I was an attorney. I wasn't smart enough to even thinking about conversions in 02. But I am today. and hopefully I'm able to share some of that knowledge and wisdom with all you guys so you can take advantage of it and lock in tax-free growth on depressed assets, right? Think about this opportunity. If you really believe in Bitcoin or really believe in Tesla or real estate, you can lock in at a depressed value, a significantly depressed asset, and hopefully it shoots up in value over the next 5 years. You hit 59.5, you're in the money, baby. You can pull all that money out tax-free or just leave it, let it roll, no RMDs, pass it to your spouse on death, pass it to your kids tax-free on death. It's amazing. Last best tax shelter out there, and they haven't closed the loop. There's no income limitations on conversions yet. It could happen in the next several years. So really good opportunity to jump in on the power of the Roth IRA conversion. So happy holidays. If I don't speak to everyone before Christmas, happy Merry Christmas, Happy New Year. I will speak to everyone again before New Year's. Other than that, going to kind of sign off. I saw one last question on cryptos. Yeah, I'll do an update on crypto. We're working on a multi-signature option. We're going to be moving off Gemini to Bitstamp. So we're really excited about that, trying to get people the ability to hold their cryptos with more control, based off what's happening in the crypto marketplace. So we're super focused on that. But ultimately, just want to wish, again, hope everyone has a great holiday season. Spend a lot of time with your friends and family. All this stuff's important, but ultimately be with your family. That's the most important. And hopefully while you're watching this is not just for you, but for your family, right? You can leave a lasting legacy to your spouse, to your kids, to their kids by building a huge retirement nest egg, right? There's nothing that's more satisfying than hearing clients tell me that, hey, Adam, I'm over 70 and I don't really need that much money, but I'm going to buy my kids a house or my grandkids. I'm going to just take a Roth IRA distribution, take $100K out and literally give them a down payment for a house. And you can do that. You'll be able to do that if you follow these 3 rules. Start early, contribute consistently, and trust the process. You will have a monster nest egg. Even if you're just buying S&P 500 for the next 20, 30, 40 years, just doing nothing else, you will be rich. Okay, so Merry Christmas, Happy Holidays. Wish everyone happiness, health, and prosperity for the new year. And talk to everyone again soon. Next video will be on Secure Act 2.0. Take care and be well. Thanks again.